In this lesson, we're going to begin discussing certain patterns. Certain patterns give us an opportunity to trade with a high probability of success. The first pattern we're going to look at is an inside bar or wedge pattern. As we go through this lesson, you'll realize that inside bar patterns and wedge patterns really are consolidation patterns from a previous lesson. However, when identifying the inside bar pattern and wedge patterns, there are some specific nuances that will help us understand where the trade is, where it needs to occur, and even where these patterns have a tendency to break down, meaning they're failing, therefore they're off the table. Let's get right into the chart. If we focus on the middle portion of the chart, you'll notice that this is really a consolidation pattern that we've already discussed. However, the question is, how do you take a pattern like this and recognize and understand where the actual trade can be? Because when we look at a pattern like this, all we really see is a lot of back and forth behavior. The market goes up, then the market comes back down, up again, and down again. And the issue is that's not really helpful. Where's the trade in here? Where does the high probability trade exist? Something that we can sink our teeth into and understand where the odds are really in our favor. Well, it does exist, so let's unmask it. So when you look at a specific portion of this consolidation pattern, for example, right in this area here, there is something specific that as traders we need to know about, and something that's very identifiable that repeats in the market over and over and over again, and therefore it is something that is a tradable opportunity right in front of us. So let's unmask it, unpack it a little bit, and see what we have. Remember, we call it an inside bar pattern or a wedge pattern for a reason. So when we see a candle on the chart that's a little larger than some of the other surrounding candles, and we see the subsequent candles begin to stay in the range of that larger candle, it's an inside bar pattern in development. So the candle in question that I'm focused on right now is this green candle that made an up move. Now you'll see candles make an up move all the time. The market goes back and forth. That's normal market behavior. However, when the candles after that tend to be staying in the range of that initial up candle. And here's the key. As long as you don't get a candle that closes below the first green candle that we identified, the market is maintaining the inside bar pattern or inside candle pattern. So it's also consolidating inside this candle to move higher. If it was flipped around and it was a red candle down and we were consolidating inside that red candle, that would be an inside bar pattern or inside candle pattern to be moving lower. In this case, the market is consolidating to move higher. So my point here is that you can see, even though the market came down to test the bottom portion of this candle, you never got a 10-minute close below that candle. And what that means is there was not a candle closure below the low of the initial up candle. As long as the market does not close below the initial up candle in this case, then the inside bar pattern, which is also a consolidation pattern, is intact, and the market is telling you that it wants to go higher. Now, inside candles or inside bar patterns don't have to be tall candles necessarily, although they're the easiest to identify. But when you look at the next phase of the market, after we tested the low of the initial up candle, the market made a couple of candles higher and then began to consolidate again. And when it began to consolidate again, what did it do? It stayed inside another green candle, not having any candle in this 10-minute span close below the green candle, which creates another inside bar pattern. Consolidating for a while, building energy in an inside bar fashion, getting ready for another move higher. So the market will have a tendency to stair-step its way higher and stair-step its way lower at times, but it also gives us the opportunity to identify beforehand what the next likely scenario is for the market based on the fact that it's consolidating in an inside bar fashion. So the idea is, in a perfect world, we would love to be able to buy the market at the low near the low of the inside bar candle. Ideally, we would like to buy the market near the low of these two candles. Why is that? Because if we can and the market closes below that candle, then we know that we're wrong and we can move out of the trade because the inside bar pattern will have failed. Now, what else is important here that we can point to from other lessons that gives us an indication of when the market may be getting ready to move higher? How long did the market consolidate in an inside bar fashion before breaking higher? Well, this first area, including the initial up candle, the market was consolidating in this zone for 10 candles. That number 10 remains important over and over and over again. After 10 candles, it started to move higher. Then the market consolidated again in this little unassuming inside bar pattern. Now, I use the term unassuming because most people, just looking at this chart, wouldn't necessarily be able to distinguish and identify a very specific pattern developing that was telling you the market was getting ready to move higher. It was building energy to move higher. After this initial 2-candle move, we started consolidating inside the top candle, never closing any of the 10-minute candles below that second green up candle. And what happened? After the 7th candle, the market put in a doji candle, another one after that. The market is telling us that it's getting ready to move higher. A trader had the opportunity to buy this market near the low of this candle. It consolidated for 7 or 8 candles. That's in that zone between 6 and 10. And what happened? On the 10th candle, the market broke higher and kept going. Now, this area on the chart may look like a bunch of back and forth behavior to most people. However, if our eyes are trained to be looking for certain things, such as an inside bar pattern, for a specific period of time, with a potential tip-off that there's going to be a trend change, then even unassuming areas on charts can be extremely meaningful if we know what we're looking for. Can you spot another inside bar pattern on this chart? Well, how about this area right over here? This is a pretty well-defined inside bar pattern telling you that the market is consolidating to move higher. Now keep in mind, sometimes the market's going to move higher for a few points, and sometimes it's going to move higher for much more than a few points. The concept is, as long as we can identify a pattern where the market is telling us a certain thing is likely to happen with a high degree of probability, and we can use that information to our advantage even if we get 3 points out of the trade, or sometimes we can get 10, 15, 20 points out of a trade. You never know exactly what the market's going to give you. However, in a later lesson, we're going to discuss how to best prepare for getting the most out of a trade. Back to this inside bar pattern. As long as the market didn't close below the low of that initial up candle, then that inside bar pattern was valid, it was active, and it was the market's way of telling you it was preparing and building energy to move higher. A couple of nuances about inside bar patterns. Ideally, we don't want to be buying the market near the top of the inside pattern. So up here, that's a tough place to buy the market, because if the market starts to trade down towards the bottom portion of the candle, we're going to be out of the money and it doesn't feel so good, and you're going to start second guessing the trade itself. So the idea is we would like to buy the market down towards the lower portion of that initial up candle. You're not going to always be able to get the market at the lower portion. It doesn't necessarily always trade down to the lower portion. Sometimes yes, sometimes no. And the market's not going to always do what you want or what I want. The market does what it wants to do. Our job is to take what it gives us. And if you can identify a tradable opportunity where the odds and the probabilities are in your favor, then you'll win more trades than you lose, as long as you continue to play by the rules. And the rules here are, as long as the market did not close below the low of this initial up candle, this inside bar or wedge pattern is active, and it's telling you the market is building energy to move higher. Let's take a look at the flip side in a downward trending market. So the market is trending lower, and at some point you have to believe the market's going to find an area of support and reverse higher for at least a period of time. And that seems to be what was happening here. When the market found a low, stopped going lower, and appeared to reverse trend. However, that last red down candle is what we're going to focus on. Even as the market appeared to have found some semblance of support, it began to trade sideways and then started to edge higher, but look what happened. It was never able to close above the high of that red candle, and that being the case told you that the market still had downward pressure, and until and unless the market closed above this red candle, that market was headed lower. Number one, it's a good way to stay out of trouble. If in fact you thought that this area may be support and the market was going to reverse trend and trade higher, you know that until and unless that market can close above on a 10-minute candle on this chart, for example, if you were using an hourly chart, it would be an hourly candle. If you were using a half an hour chart, a 30-minute candle, it would have to close on a 30-minute candle. It doesn't matter what time frame it is, until and unless that market can close a candle above that last candle in this example, then the market is not free and clear to move higher. It still has downward pressure and is still prone to go lower. So you can use these patterns in two different ways. You can use them to enter trades, and you can also use them to stay out of trades. So if you were thinking that this was an area where the market was going to reverse trend, you certainly could wait until you got a close above this candle, this red candle, to confirm that the market was going to trade higher. We can pick out one more inside bar pattern just looking at this page real quick, and we can see that this green up candle, the market never closed below the low of that candle for this entire sideways move. The market was consolidating, and this is also considered an inside bar or wedge pattern, never closing below that low. The market is still telling you it wants to go higher until and unless you get a 10-minute close below the low of this green candle. We use inside bar patterns and wedge patterns to our advantage each and every day in all markets, on all charts. They show up over and over and over again.